Mr. Agman's latest pronouncements and the impact they had on the market. I mean, the headlines say the markets move because of him. Do you think so?
Maybe on the margin. I think the reality is bond yields have moved an awful long way in the last 7 months. If you go back to the Silicon Valley Bank low of about 3.3%, we got to just over 5% yesterday. That 170 basis point sell-off over the last 7 months, we haven't seen anything like that. You have to go back to the early 1980s to see something like that. So that's a lot of pressure to exert through the funding system. It also created very high real yields in the market. You're headed into an FOMC meeting next Wednesday where the Fed will look at the way financial conditions tightened. I think the market just stepped back and said, you know what, this is as good a level as we're going to see for the time being to buy.
The kind of movements you've been talking about and over the duration that you're talking about have attracted multiple explanations. I mean, a lot of people are reading these conditions in very different ways. What do you ascribe the movements to?
Well, if we look at that 170 basis point move, half of that, I think, you could have expected. Coming out of the policy response to the regional banking crisis in the U.S., you could see that yields were going to retrace some of that. So maybe half of the move. I think the reality is the pain was really exacted after the September 20 FOMC meeting. The Fed tried to navigate saying that they're pausing hiking rates, but trying to remain hawkish so that financial conditions didn't get out of control. And that's effectively when the market started to unravel. That's when we saw the old high in the 10-year Treasury, which was actually set almost exactly a year ago at about 4.3, 4.35% break down. And then the speed of the move from September 20 to yesterday is, I think, what really caught the market off guard. So I go back to, it's the Fed. The Fed was very hawkish. They tried to put not only higher for longer on the table, but also maybe higher forever. And the market sat there and said, why should we take lower yields in the long end if we could just hide in cash for the time being?
So the Fed is cautious and suggesting that they're worried that perhaps the inflation picture may not yet be under the kind of control they want to see. Mr. Agman seems to think that the economic data we're seeing is not reflective of the economy and it could be weaker than suggesting. Your forecast is you're cautious about the inflation to the upside problem, right?
Yeah, I think the reality is that growth and inflationary pressures have come down an awful long way. When you look at inflation in particular, there's the haves and the have-nots. You could look at the trailing 12-month data, and yes, it's still in that high threes in core CPI, 3.7%. If you look at personal consumption expenditures, around 4%. So not anywhere near the Fed's 2% target. But if you start looking at some of the more recent prints, take the last 3 months of core personal consumption expenditures in the U.S., which is what the Fed looks at, take those 3 months and annualize it, you're at 2.16%. That's bang on what the Fed is trying to target at 2%. So I think the Fed, when they go into next week's meeting, going to step back and say, hey, we're getting to where we want to go. The tightening in financial conditions is going to help. Let's figure out how to get a better message out there, but we're not going to do anything for the time being.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.